Coming up today, stocks finish the week lower, Bitcoin surges to a record high, what to expect from crypto week, drone stocks fly higher, the treasury posts a surplus in June, and why the roaring 20s look set to continue. Let's have a good one, guys. Well, there we have it, the second week of Q3, actually finishing a touch lower, looking at the indices. And apart from a few industrials, energy, oil and gas, it was actually mostly mega cap tech standing out here today. Whilst we did see a number of hot stocks, risk on, and financials come off. I think Visa and MasterCard are especially under threat from the growth in stable coins. We'll take a look at that later on. And just switching this heat map over to the weekly performance to see how we finished here. Telecom also coming off quite a bit, software stocks, and some other high beta names. Ticking down along with cybersecurity, and it was energy, industrials, and of course the AI leader Nvidia leading the pack higher, hitting 4 trillion market cap for the first time that we've ever seen a company pass that milestone. And stick with me today because in addition to Bitcoin, I'm also going to talk a bit about earnings season as we ramp up into that next week, which is a busy time for options traders. So we're going to talk a little bit about implied volatility, and I'll also show you some of the hottest stocks out there today, like drones ripping higher, as we just got some key news there. But first, as usual, let's start with a bird's eye view of the market before we drill deeper into what's moving underneath it. S&P 500 finishing just above 6250 for the week, just a touch lower where we finished last Friday, with the fear and greed index finishing just in the extreme greed zone, as we've now gone over a month of it being in either the greed or extreme greed zone, along with the bulls coming back and Wall Street in a big way, lifting their year-end price targets for the S&P 500, and the market continuing just to shake off or just outright ignore any negative headline, showing once again how resilient this market is, not just this year, but you think back over the last 5 years, what we've seen. The pandemic, the fastest rate hiking cycle in history, inflation reached 40-year highs, the highest level of geopolitical tension many of us have seen in our lifetime, tariffs from the world's biggest economy, to levels not seen since the 1930s. And what does the market do throughout all that? Has a quick sharp dip, convinces everyone we're about to go into a recession before doing a classic gotcha V-shaped rally, for which on many measures, this has been the strongest recovery after a correction that we've ever had. And in fact, looking at a composite of bond market and stock market volatility using the MOVE index and the VIX index, we're right down here near 3-year lows. But more importantly than that is how quickly we've got there in this monster volatility crush in financial markets, which is the steepest crush we've had since early 2020 when the system got flooded with new liquidity from the Fed and heaps of government spending. But that's the thing, we haven't got that this time. There's been no Fed put. There's been no massive quantitative easing, money printing by the Fed. The market's pretty much recovered on its own, and it looks to be happening once again. The price analog we're getting here with that of the late 90s, 1998 in particular, saw a sharp sell-off before having a good recovery, and the market kept continuing higher for another year before eventually topping out. And what really powered the stock market back in the late 90s was all the buzz and excitement about the internet. And I've got to say, the parallels are remarkably similar, because I remember myself getting into the internet in the mid-90s, and it was considered a niche for nerds, young kids, gamers. Big companies didn't take it seriously. A lot of people doubted it. Even Nobel Prize-winning economists like Paul Krugman said back in 98, by 2005, it will become clear the internet's impact on the economy has been no greater than the fax machine. Then a quarter century later, said the same thing about ChatGPT. But I think a lot of people don't realize just how fast AI is changing the world. And that's because it's happening bit by bit. But even just in this last month, we've seen drastic improvements in the AI model. GPT, Gemini, and Grok just coming out with a really powerful latest version. And not too far behind is Meta, as Mark Zuckerberg's thrown out there $100 million packages, poaching the best and brightest in AI from other companies like OpenAI. He's trying to build a dream team and has the immense cash flows from his traditional advertising business to do so. And again, at 28 times trailing earnings, it's not all that crazy a valuation for one of the most exceptional, profitable businesses in the world. And actually leading the pack today is the mega cap tech, the cheapest on pretty much every valuation measure, Alphabet Google, close to breaking out to multi-month highs. We're just a little over 2 weeks away from earnings, which I'm excited to see. I think there's a good chance it could surprise many people. And what you'll see a lot of the time is the market will kind of wait until it gets the earnings as kind of like a de-risking, and then you'll see big money make moves. And you can kind of already see signs of it here on the chart, accumulation, buying the dip. And so I'm expecting Alphabet to beat, and I'll be looking to play that with option, which I'm going to talk more about a bit later on in this video. But first, let's just pivot to crypto, which has really grabbed the spotlight this week, with Bitcoin surging to a record high, above $118,000 for the first time, as it pretty much continues to track step for step global liquidity with about a 2-3 month lead, which has been on the rise as we're in a global monetary easing cycle, and big governments around the world are putting their foot on the gas when it comes to fiscal spending. And there's quite a few things going on here. We just saw a record amount of shorts get liquidated, and crypto ETFs seen some of their highest inflows ever, especially into Ethereum. Relatively speaking, the largest one offered by BlackRock and their iShares product Ether had its biggest one-day flow yesterday. They had to buy $300 million worth of ETH, multiples of what was minted yesterday. And there's a look at Ether, which is still relatively small. Assets under management, 5.2 billion. And you compare that to the Spider Gold Trust, 100 billion, and silver, 17.5 billion, and the iShares Bitcoin Trust, 77 billion assets under management. And so I continue to believe that Ethereum does have room to run here, and this is a good sign, seeing a breakout this week, and that could accelerate next week as we're going into what's known as Crypto Week. The House of Representatives expected to vote on the Genius Act, which already passed the Senate last month, and this is kind of like the watershed moment. Enables private companies to issue stablecoins, and they're basically just a way to digitize the US dollar. You buy a stablecoin from a company with your US dollars, they issue you stablecoins, then they take the proceeds and put it into the US treasuries, and that's what Circle does with USD coin. So it's backed one for one, it's trustworthy, and they can earn a yield on the treasuries. And this has the potential to have tectonic changes in finance and beyond that, especially in retail. Walmart and Amazon, two largest retailers in America, already considering launching their own stablecoins. And like I've been saying for a while now, it's Visa and MasterCard in the crosshairs. I think they're the most disruptible companies in the world, been operating a duopoly for decades, and we're going into a world where paying 1%, 2%, 3% just to send money is kind of ridiculous, and so is waiting a day or two to receive or send funds. It's kind of outdated with today's technology. And just looking at pricing here in prediction markets, should be a done deal, 93% chance. Both chambers of the US Congress sign it into law this year, as this admin has made it clear they want to lead the world when it comes to cryptocurrency. And this could get so big, these stablecoins could actually become one of the largest buyers of US treasuries, which helps to keep yields low when there's more demand for bonds. The US government doesn't have to offer such a high rate to attract capital, and so it does play into the handbook of the US government wanting to lower rate. However, counteracting that is if we do get lower rates, that means these stablecoin companies like Circle, company behind USD coin, earns less in interest on their treasuries. However, their growth and adoption and usage could very well overwhelm that. Just looking at the price action here, ever since it came onto the market, it has pretty much defended its volume weighted average price, and just touching it here again today, but looking a bit better. And as I've been saying for over a year, what I consider one of the best ways to play crypto is through Coinbase, as they are already pretty much the company that governments, institutions, and other large companies are partnering with for all of their crypto needs. And so the Genius Act should pass, and that should mean the good times keep a rolling, especially for Ethereum, as the finance world is coming around to it very quickly. And here's a look at some of these Ethereum treasury companies. Bitmine Immersion Technologies, which Tom Lee's chairman of. Crazy volatility, just like others like BTCS, SharpLink Gaming. But look at these volumes. 54 million shares traded today at $21 a share, and it's only a $1.4 billion market cap company. And my favorite as well, Bit Digital, which I've got a bullish position in. Still not even quite $1 billion in market cap. And so this is just another way retail investors can play Ethereum, because like Tom correctly points out, they have a distinct advantage over just owning the underlying, in that they can go to financial markets and issue new equity or debt and turn around and invest that. And especially with Ethereum, since you can stake it and earn a yield, that can be reinvested along with other strategies to increase one's holdings of ETH per share. Whereas an ETH ETF, which is nothing wrong with having, that's just a fixed holding per share. And obviously this little nifty trick has worked well for Strategy, formerly known as MicroStrategy, as they continually trade at a hefty premium to their underlying Bitcoin holding. So if it works for Bitcoin and Strategy, why can't it work for Ethereum and other companies, especially when Ethereum spits off a yield? I think that allows for compounding. And we could be just getting started, considering Ethereum still has to rally over 65% just to hit all-time highs when Bitcoin is already there. And we've been seeing other big moves from companies like Robinhood looking to build on top of Ethereum with tokenization, another new industry that this crypto will help unlock. Moving on, we got earnings season for Q2 ramping up next week. It's always kicked off by the banks. So before the market opens on Tuesday, we'll get to hear from some of the biggest Wall Street banks. They could get markets moving. Then Thursday will be a big one. Taiwan Semi and Netflix. However, as usual, it's normally towards the end of the first month of the quarter it really starts ramping up. And so it'll be the following week, Tesla, Alphabet, Intel. Then as we approach the end of the month, we get a few more mega cap tech and a few hot stocks like Robinhood, Reddit, and Coinbase. And so analyst expectations have actually come down a lot of what earnings should be this last few months, especially after the tariff. So the bar's been set relatively low. And if these key companies come out and smoke those numbers, then that's a good sign for the stock market. And in fact, looking at the price action in the NASDAQ, it's kind of already expecting that. And so earnings season is a good time for options traders. Getting a lot of moves, a lot of volumes, and probably the most simplest strategy, although you definitely got to be careful and know what you're doing, is selling volatility or strangles or iron condors before earnings. As structurally, there's a risk premium built in, meaning quite often options are priced for bigger moves than what happens on average. Just looking at United Airlines here, for example, the average move the stock makes the day after earnings is 6.5% up or down, where options are implying 9.7%. And so a long-term strategy that works, if you can handle the drawdown, it's similar to selling insurance, is to sell an out-of-the-money call and an out-of-the-money put at the same level of the options implied move. So on United, that would be approximately 10% lower and 10% higher. Now, of course, every now and then you'll get a massive gap. That's what can cause a loss and drawdown, just like an insurance company. It has to pay out on claims, but over the long term, if you can manage risk, you will earn a premium. But that's for earnings events, which are pretty straightforward. What about the rest of the time? How do we know if options are cheap or expensive? And this is something that most options traders completely ignore. They just randomly buy and sell options with no regard to the price. That's the same thing as going shopping for a new product or just ignoring the price. And just to illustrate with this simple example, say a stock is expected to move $1 up or down by option expiry. The fair value on that option is 50 cents, because if you were to buy the option, half the time you'd make 50 cents, the other half you'd lose 50 cents. There is no edge. Same deal if you were to sell it for 50 cents. But what happens if we could buy it for 40 cents or sell it for 60 cents? Half the time we'd make 60 cents, the other half would only lose 40 cents. So how exactly do we know what an option is worth? Well, I've been developing an options valuation indicator for the last 2 years now called option IV, which stands for implied volatility, FV, which stands for fair value. And this is my second model. There's quite a lot's gone into it. It's calibrated to real-time market conditions, measures the relative volatility of the stock versus the market, and also uses fixed futures for forward-looking volatility expectations to help come up with a fair value for the implied volatility of at-the-money options approximately 30 days out. As a baseline, we can then work with to determine if options are cheap or expensive. We're just looking at NVIDIA here, and you can see it's got the current fair value at 35.5. The green line is the bottom 10th percentile of fair values over the last year. The blue is the average, and the red is the top 10% average readings over the last year, just to give you a visualization of how volatility is tracked in the stock. And so we can see here my indicator's got fair value at 35.5. On NVIDIA, which was the most traded options today, and just looking at my brokerage platform here at the NVIDIA options chain, if we go approximately a month out, 28 days to expiry, you'll see the current implied volatility on at-the-money options, 34.8, puts 38 on calls, so it's average about 36, which is pretty much exactly where my indicator says implied volatility should be. And that's what you'll find a lot of the time. The US options market is incredibly efficient, but not always. There are temporary mispricings, especially in hot retail stocks, and especially when there's dislocation and volatility in the market overall. And so if you're an options trader, I encourage you to come back to this channel, Click Capital, tomorrow. I'm going to upload a tutorial video going deeper into this, showing you exactly how this works. And I'm also going to show you how you can get this indicator for free. It's something I've spent 100 plus hours developing. And it's my biggest focus as an options trader, trying to work out whether options are cheap or expensive to identify opportunities. So if you're an options trader, you absolutely need this, and nobody else has it. So be on the lookout for a tutorial video from Click Capital tomorrow, and we'll dive deeper into this and I'll show you how you can get it. Just moving on to what else is attracting attention out there today. Wall Street coming around to rare earth stocks. After we got that blockbuster headline yesterday, the Pentagon taking a $400 million stake in MP Materials, which surprisingly is the only rare earth miner in America, as the government's just realized they're far behind in their supply chain security for these critical minerals of the future. And I believe this is just the beginning. We've seen analysts upgrade their price targets, and this is why the Pentagon invested. They want the stock higher. They want the company to have more capital to expand, and they want to ensure no other foreign buyers can take a controlling share of the company. And rare earths are important for military products, and one of America's biggest adversaries, China, by far and large the leader, not only in reserves, but in production and refining of rare earths as well. And they did pull out that card in the short but heated tariff wars of April 2025. They didn't just tariff it, they blocked export of rare earth, which is an economic attack. And that's why it's no surprise to see a strong political tailwind here. And Wall Street jumping on board. Just looking at MP Materials today, just taking a bit of a breather, along with a few other rare earth stocks, as MP is still well out in front. But there are some other American headquartered rare earth stocks that I do think that are also going to benefit from this and are actually needed to help America achieve its goal of becoming quite a bit more self-reliant for rare earth mineral. Aperion X getting a momentum thrust signal there today, and the rare earth stock that I'm invested in also looking pretty good technically here. Idaho Strategic Resources, who have claim to the largest rare earth deposits in America and already have positive cash flow from gold and silver mining to fund that expansion. And as a shareholder, I'd love to see them get some government support as well. What else has government support? And we saw that again here today, are drone stocks, as we're getting more and more deregulation to put a tailwind behind this important industry as well. The now and future of war is going to be mostly about drones. We've already seen that in Ukraine, helping to go on the offensive against Russia using drones. Now the Pentagon's increasing its investment in drone technology, and the Defense Secretary ordered the removal of policies slowing drone development, aiming to boost US drone manufacturing. And so even though we saw a lot of these smaller, high growth, story name stocks come off quite a bit here today, it was actually drones that stood out. New one onto the market, Aero, ripping up 29%. Unusual Machines, UMAC, monster day here. And here's a look at the current US drone landscape, with UMAC a key component supplier, but also other big players. Red Cat, which also ripped today. Anduril, which hasn't come onto the market, but that is going to be another big time retail favorite. Investors already getting excited about it. And of course, there's other tech software companies and intelligence that are going to help to shape this industry, and more traditional defense companies too, like Kratos, catching a bid. There's Aero Environment looking super strong on the chart here. And of course, Red Cat. You want to keep an eye on this one. I think it has strong potential to become a retail favorite. Looks to be just pushing up off this base. One of the biggest volume days we've seen in a while, and still not even $1 billion market cap. And here's a look at their website, defining the future of aerial intelligence. And I wouldn't be surprised to see more partnerships and announcements with companies like this coming from the government. And I mean, with a name like Red Cat, that sounds to me like a ticker retail could really get behind. Hot name, a hot story, a hot industry. It's got all the right ingredients for this to attract a premium valuation. Others will call it a bubble, but bubbles are actually a good thing. Just like the internet bubble helped to attract a lot of investment that actually created the infrastructure for the internet, helped with innovation and new technologies. And then comes the natural crash, which helps create efficiency, weeds out all the weak players after the boom, creates hundreds of them. And drones is just another one of those secular trends that we could still be very early on. And so a boom and bubble here would actually help this industry to get off the ground and flourish, with investors more focused on growth and potential without the need for profit straight away. Gives these companies the research and development budget to innovate, create new products, and hopefully us investors can make some money along the way by helping them do so. So again, keep an eye on Red Cat. I think this has a lot of potential, not just right now, but over the next couple of years, along with many other companies on my themes watch list, which you can download for free by clicking the link below this video. Just moving on to some macro, getting some sharp words here from Trueflation, what many of us in finance have come to rely on for a real-time look at how inflation's tracking in the US economy. Posted on their X account today, in the last 6 months, inflation dropped 1.4 percentage points, and the Fed remains asleep at the wheel. Why? Because they keep using delayed data. It's time for a change. Interest rates aren't just a number, they have a real impact. Also noting today that in the last 12 months, Argentina has dropped their inflation from a whopping 263% to 33%. And just imagine that for a second. Prices increasing in triple digits. Regular folks couldn't even afford to go and buy groceries. And that adds to rampant crime. How'd they get it under control? It's thanks to this guy here, who took a chainsaw to public spending. And so that's the misconception. People think it's interest rates that largely drive inflation. It's not. We've seen rates drop many times before, in fact, hundreds of times in history around the world, and it hasn't caused inflation to go up. What causes inflation to go up, like it has done pretty much every time, is from the government, an increase in government spending, and especially an increase in the supply of currency, like we saw coming out of 2020. That's what caused inflation, and Jay Powell just cutting once or twice is not going to create an ocean of new currency like he did back in 2020, and in fact, like he's been doing for almost 10 years now. And so he's most likely going to stay on hold later this month, but the pressure is building on him, especially if he doesn't cut in September. We got an official statement from the chairman of the board of Fannie Mae and Freddie Mac today. I'm encouraged by reports that Jerome Powell is considering resigning. I think this will be the right direction for America and the economy will boom. And I think just as important for the economy is helping to relieve pressure on millions of low-income consumers struggling with the high level of debt. Not to mention small businesses as well, would help them refi at lower rates, put a real tailwind behind just about everyone. Also up on deck as we approach the new August 1st deadline on trade deals is a big one, the European Union, as it's still unclear whether both sides are agreeing in principle. But I don't think the European Union is in a great position to negotiate too hard. They've got growth much lower than the States and many other issues to deal with as well. In addition to the United Kingdom, which is pretty much in the same boat, they saw their economy contract again in May, missing expectations. And this is an issue that's been persisting for some time now, as Europe appears to be in a structural decline. And I remember when I first got into finance, France in the early 2000s. Europe and America were pretty much on par with each other in terms of size, relevance, influence, trading volume, IPOs, etc. But now Europe's just a shadow of its former self, especially if you were to go back 100, 200 years. Even saw JP Morgan CEO Jamie Dimon say today, "You're losing to Europe." And so why is the old continent losing global relevance? Why has there been such a great decline of European industry? Just Nvidia itself has a larger market cap than the entire market cap of Europe's largest economy, Germany. Is the US to blame for Europe's decline? Or could it actually be the leaders, the likes of these guys? And it's actually been a talking point for a little while now that the rot is too far gone, the decline too pronounced, the welfarism, decadence, pacifism, and self-hatred too ingrained. Is the doom loop unstoppable? I'm keen to hear from my European friends. What do you guys think about this? Is it reversible, or what needs to be done? What's the future of Europe look like? Why does the United Kingdom, France, and Spain have crime rates now on par with third world countries? Is Europe even Europe anymore? London, Brussels, Paris, many other major European cities, native Europeans are now the minority, with immigrants from third world countries being carried at a loss due to their high reproduction rates and cost to the social, education, and healthcare systems, vastly overwhelming the tax revenue generated. Is that a sustainable model? And what does that do to Europe, not only culturally, but as a place for us investors to put our money behind? Because like I said, over the last 20 years, Europe's changed a lot, maybe on its way to becoming a museum into the past. Looking at the spread chart here of the European stock ETF versus the S&P 500, American stocks, it's pretty much been a structural decline over the last 20 years. And I know we've had a bit of a bump up here year to date, but when you put this into a long-term context, one could still argue the downtrend is still in place. Lower lows, lower highs, which is all pretty sad to see, if you ask me. But for some reason, many Europeans keep voting in the same types of leaders with the same types of ideologies. And I, for one, hope they can turn it around and one day invest into European companies and markets, which I don't currently do and I haven't done for years, as I just don't see good reason to do so. Anyway, as usual, that's just my opinion. You're welcome to share yours in the comments below this video. Otherwise, that's a wrap for the daily market review this week, guys. We didn't have much on the economic calendar this week, but it'll be dialing up next week. As we get into mid-month, as usual, we'll be getting CPI inflation data, and of course, Q2 earnings season starts to ramp up. We'll be paying attention to all the key names. Make sure you stay dialed in here with Click Capital. And like I said, if you're interested in options trading and want to learn how to get my options valuation indicator for free, then make sure you come back to Click Capital tomorrow, as I'll be uploading a tutorial video explaining it all to you. Otherwise, enjoy your weekend, and I'll be back with another daily market review come Monday night. Cheers.